you want to pay death tax? No. Let's remove the risk of paying death tax. Well, there's not such thing as death tax, but it's so motivating that people are willing to spend almost unlimited money to avoid paying something that's very definable.
Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials, with your hosts Josh Sheluk and Colin White, portfolio managers with Barenaked Capital Management Inc.
Welcome to Barenaked Money. It's Colin and Josh, portfolio managers at Barenaked Capital Management, as usual. And we're pulling back the shower curtain to talk about money the way it should be talked about, as usual, plainly, close off, and without a sales pitch. Look, we're here, as always, to make you better informed, to give you straightforward advice, and our only angle as a firm is to make you better off. So if you want to get started, if you want to start a conversation with us, visit betteradvice.ca. And when we say better informed, well, risk and return, those are big parts of the conversation, Colin. That's what we're talking about today.
This is going to be fun because I don't think there's anything that gets talked about more or understood less and used in more destructive ways than any other concept in the world. I'll go that far. What do you think? Do you think that this is a destructive topic used for malfeasance across the world, Josh?
I don't know if I'd go that far. That's pretty extreme.
Well, it's for effect, right? I mean, you and I have both watched countless pitches in the investment industry that talks about risk and return and the false equivalency to more risk equals more return. Therefore, the more risk I take, the more money I make. And again, there are pitches that will lean into that concept. And that's just not true. You and I both know that not to be true. So it's a multi-headed monster. There's no easy definition of risk. And because you can't define it, it's open to interpretation. So my goal today is to try to give people a little bit of a framework in their mind to kind of put it in its place so that they can turn it into something they can make a decision on. For example, a wet floor, that's a hazard. If you don't walk on the wet floor, it's not a risk. So, it's a risk if you walk on a wet floor. So I think we'll talk about some things today that are hazardous that you can just remove yourself from the room and not take the risk, and risks that may be worth taking, how to understand what that risk is and what you're actually risking, and what reasonable return expectations can look like, and the danger of having that misaligned with reality, the harm that can cause. So anyway, you have a list as you always do, Josh. Do you want to guide us on this journey?
Yeah, we'll jump into it for sure. But one of the things that you mentioned there was kind of interesting. You alluded to some of the marketing that gets put around, especially when it comes to money, risk, and return. And I think there's an angle out there that is, from a marketing perspective, it's reduce your risk. Well, that sounds awesome. Who doesn't want to reduce the risk? Why wouldn't I do that? It would be stupid not to do it, right? Yeah. And I think that it can be used nefariously in a few ways. One, it can be used to put a label on something, risk reduction, that is not actually true. Like there are products or investment strategies and styles out there that say they're less risky, but maybe the risk is just obfuscated in some ways.
Yep.
And then there's some strategies that might actually be less risky, but it's still a dumb idea because it's preventing you from getting something that might be maybe more advantageous for you.
Well, so I think what is the cost of avoiding the risk? You see, these are always about probability and magnitude. Like if something is,
I might want to walk over the wet floor if it's going to take me 5 minutes to walk around it. I might be totally happy, and I might have my rubber boots on, so I could be fine on the wet floor.
The ice cream is on the other side of the wet floor, and you really want an ice cream, So the whole thing about probability magnitude is escaped, right? And the whole thing about removing a risk is not really a risk. Like too much broccoli can lead to iron poisoning. Okay, so I shouldn't eat broccoli. That might be an overreaction. Maybe moderation would be fine to completely remove that risk, right? So it's nuanced, and the problem is that these words get taken at face value and used to motivate people to immediate action. And to your point, do you want to pay death tax? No. let's remove the risk of paying death tax. Well, there's not such thing as death tax, but it's so motivating that people are willing to spend almost unlimited money to avoid paying something that's very definable. So there is no death tax, just for the record. But it's one of those ones, managing a risk and paying way more in cost to avoid something that if you actually quantify, it's not that big a risk after all, even removing
Yeah.
probability.
Yeah. So why don't we start with this? I'll ask you the question. When you hear people talk about risk and risk related to investments and money, what do you think they're usually talking about? How are they usually defining it?
I think the fundamental mistake that people make is they confuse volatility with risk. And the investment industry leads into that. Like the investment industry will take a risk measure, but they're actually measuring is volatility. I think to an average person, if you get outside of the financial world, risk ostensibly means risk of loss. Like, what are the chances I'm going to lose this? And it's a very major thing. And I think that the investment industry hasn't done itself any favors by so closely equating perceived volatility, historical volatility, with risk. Because we love putting numbers on things. And this is where I'm going to start offending all the CFAs in the world. You can't accurately put a number on risk. Sorry, you can't put a meaningful number on risk that really encapsulates what a risk is because it's very subjective. However, we have 18 different ways from Sunday to put a number on risk, and therefore we can order it, and then we can use it to make a decision. And I think that misses a lot of very important aspects of making a financial decision. So to go back to answer your question directly, because I want to be that, I think people, when you say risk, risk is loss. Investment industry, that becomes risk of volatility. Risk equals volatility. And I don't think that that's a fair comparison. I don't think that that does anybody any favors.
Yeah, the tough thing here is to some people, volatility is risk.
Yeah.
If you're spending your money on a monthly basis that you've saved up over
Yeah.
all those years, if you're retired and need that money to live, then volatility is risky for you. But if you're
Risky to what?
30,
So it's risky to accomplishing your goals, right? So
yeah,
the
right.
so I mean, just to put it, I want to try to keep this really defined. There is a risk
Yeah.
that if your assets are volatile, that it may affect your ability to reach your goals, which absolutely is true.
Yeah. And actually maybe that's the point. The risk for an individual, the risk for an investor is the risk that they're not going to accomplish their goals.
Yeah.
And those risks come in different forms. For some, volatility might be the more meaningful risk.
Yeah.
For others, longevity or inflation or liquidity or might be the more meaningful risk.
Surprise, I'm pregnant, that kind of stuff, right?
Okay. Yes. Sure.
Well, not me, but again, I just had a friend who went through this,
Yeah.
very late life surprise. Oops, we're pregnant. That's risk.
Okay.
And it's going to affect their financial plan. So
Right. Right. So I think you're exactly right. Risk is typically thought about as volatility. Stock market's riskier than GICs. A lot of people would say that that's true, but depending on where you're sitting and depending on what your objectives are, depending on what your time horizons are, depending on what your tolerance for that risk is, that might not actually be true. If you're 30 and saving for retirement at 65, you have far more risk being in a GIC than you would being in stocks.
well, yeah, I mean, I might even go a step forward and say that you're making it very, very hard to accomplish your goal, unnecessarily hard. You're picking a path that's very, very difficult. Is it possible to fund your retirement using only GICs? Sure. Is it going to give you likely of the best outcome? Not statistically, no. But again, that's an understand. There's a risk in not taking enough risk. Ooh, look at that. I use risk on
Mm-hmm.
itself. Uh, because if we're looking at, and I think you're right to bring it back to accomplishing client goals. In the long run, currency exposure doesn't matter. Like over any 30-year period, currency is neutral. Problem is, in the long run, we're all dead. So, it's got to be variable within a range within the important time horizon that we've set for ourselves. So, but to go back to my earlier comment, the industry does talk about the risk of investment separate from that. Like they'll say this is a high risk, low risk, medium risk investment, regardless of the time horizon of the person that's buying it. And to your point, I think
Yeah.
the person that's buying it would experience that risk differently. It's not high risk for somebody to have equities at age 30 with a 65-year retirement. That's not a risky thing for them to do. But the product may be described as risky because it is equity
Yeah.
and it has higher volatility.
Yeah. And actually, we as an industry have literally quantified risks, especially when it comes to mutual funds and ETFs, right?
Yeah.
In Canada, we have put standard deviation bands around low to medium high, high risk investments. So we actually, us CFAs actually have quantified risk down to an exact measurement that we put on the financial products that are often sold and marketed here in Canada.
Decimal points and everything, buddy. Decimal points and everything.
And
That's when you
and
know it's
and
serious
just
math.
standard deviation is just a volatility measurement. That's all that it is.
Yeah,
So
a historic volatility measurement.
that's for sure.
So
Yeah.
no, but
So yeah.
the challenge is that it's a very, very important topic. We seek to simplify it. Regulators seek to simplify it, but in the simplification, it loses its potency as to what it really is, and can lead to making some flawed decisions. And I think that's what we're trying to get to in this conversation, to try to explain to people how one product may be risky for one person but not for another. And sometimes it's the opposite of what you expect. Because back to your example, a 30-year-old is investing in nothing but GICs because they don't want to take the risk of the stock market, is actually taking a much bigger risk. You know, the risk that that's not going to be able to keep up with inflation and fund the retirement they expect. So risk comes in different ways.
Yeah, trade-offs there for sure. Yeah, so just I think as we go through the conversation, it's worth our listeners keeping a bit of a broader view of risks that are out there. So it's volatility to some extent. You got temporary declines, you have permanent declines. It's inflation, the fact that the cost of things is going to go up over time, and there's a risk to that for you financially. It's liquidity. So when you need cash, you need to have cash on hand or something that can easily be converted to cash to cover that expense, that cost, whatever it is. And there's a behavioral risk too, that even if I am 30 and I have 35 years and the stock market is very likely almost guaranteed to be up over that 35-year, if I can't deal with the volatility behaviorally, then I'm still hooped.
Yeah, liquidity is one that's really rearing its head right now because we've seen the proliferation of all these private products that have maybe gone too far down market for people who can't deal with the risk of illiquidity as well as others can, because it's been sold to them as something the ultra rich do. And this goes back to, do you want to invest like a pension fund? No, you don't. Like, you're not a pension fund. You're not immortal, and you don't have the ability to tie money up for 40 years without causing you pain. So, no, you don't want to be that. But we have product out there that has positioned themselves that way. So yeah, liquidity, I think, I want to stick a bit of an exclamation point on that. You know, liquidity is the thing. I often talk to people about GICs because, you know, the Canadian banks are great at selling GICs. It's a really low cost of capital for them, and they make a lot of money off of it. But you take a look at, you know, if I'm going to advise a client to give up access to their money for 5 years, I want to get paid for that. I think that there should be a payoff. Like if I'm not going to have access to my money for 5 years, I want to get paid. When that interest rate's the same as what I can get with a 1 year GIC, it's like, well, why would I tie my money up for 5 years for what I could tie it for 1 year and get the same amount? More complicated answer is where you expect interest rates are going to go, and let's just stipulate that nobody knows where interest rates are going to go, and say that, you know, the average consumer is making a decision at a moment in time. But you're buying a 5 year GIC when you could get the same, you know, absolute return by buying a 2 year GIC. You know, so you're giving up access to your money for 3 more years, maybe hoping that interest rates are going to be lower and that's going to turn out to be a good decision. But I don't think the average consumer is in a position to have a thoughtful decision on, or thoughtful opinion on where interest rates are going to be in 2 years' time. So anyway, it, liquidity is a thing, and I think it's an underestimated thing, because the other thing is people put money in the stock market. If it's publicly traded, it's volatile, but you can get out, you can cash it out. It doesn't have the liquidity risk to it. You just may have to not sell it at a peak, which goes back to the psychological sign that you're talking about, getting somebody to sell something that's not at a peak. But the liquidity of the public markets is something that's absolutely in their favor compared to some of the alternatives.
Yeah. So you may reject the premise of this question. So
Oof.
I'll just preface with that. But why should riskier investments earn higher returns?
I don't. I understand where you're going with the question, and so I can accept it for what it is. If I am taking on additional risk, then there should be a compensation for that. Now, that's just how the world should work. I'll challenge you on this one. Do you think that overall the capital markets operate on that with that as a fundamental principle? Now, execution wise, it's not always executed on, but there's a kind of a global principle. If I'm taking more of a chance, I'll say chance instead of risk with my money, that I should be compensated for that. Otherwise, why would I take on the risk?
Yeah. Well, and that's exactly right. If you're not going to get compensated for taking on more risk, why are you doing it?
Yeah,
Right. And so I think by and large the market does operate with this principle upheld. There's exceptions, and I do want to talk about some of those exceptions, but by and large, the answer is yes.
I mean, Tom Brady, told us that fortune, or Matt Damon, who was it that told us that fortune favors the brave? You know, yeah, there's
One
a
of those guys, yeah.
yeah, there's a lot of really fit, determined bodies laying on the side of Everest. Just because people who take risks make a lot of money doesn't mean that everybody takes risks makes money. And there's a lot of failures out there that don't get discussed. And I think that that's maybe in the background what holds people back. But for those that don't get that piece, it's like I want to take as much risk as possible. I want to make the best return as possible, and eventually that relationship just breaks.
And that's one of those examples where necessarily taking more risk does not lead to more return, or like it probably is not expected to over time. And you could think of something like 0-day options trading or something like you're, and these, just for everyone's knowledge, these are investments that most likely are going to expire worthless at the end of the day, unless you see an outsized market movement that is in your favor at the end of the day. So you really need to have your forecaster's hat on for that. But these are, I think, if you spend enough time mixing around as a retail investor, for sure, with 0-day options, you're probably going to end up losing all your money at some point. And so those are risky investments that have a very low expected return given enough shots at it, in my opinion. So there's those types of scenarios.
So when you buy tickets to the lottery or you go to the casino, you're taking a risk. But it's very, very well proven and understood the house always wins. So, can you be the exception and make money? That's what everybody dreams about. But, there's a situation where taking more risk will eventually end up losing all of your money because mathematically there's a certainty to that.
Yeah.
Now, that same kind of thinking can leak into the investment world where there's a big opportunity because there's mineral rights about to be granted, or there's new technology, or I've cured cancer, or clean energy, or whatever. There can be these really great stories, but what is the probability of them actually playing out? And those sometimes that's almost impossible to know because there's never the really, really aggressive stuff. Then one of the reasons that the expected returns are so high is that there's very little visibility on the outcome. That has got significant risk of loss. You buy the S&P 500 ETF, the chance if your money goes to zero one day, we have bigger trouble than the fact that your ETF is not worth anything. That means 500 of the world's largest corporations all went bankrupt the same day. We're probably living in caves hitting each other with sticks. So, now risk of volatility, 100%. There's absolute risk of volatility in that. It doesn't have a liquidity issue. So again, understanding these different types of risk when it comes to investing, because the word risk gets used in all those different situations, it means something different.
Yeah. I think again, by and large, this holds true. This relationship holds true when we look at financial markets. I think stocks and bonds is a good simple example to look at. So you can buy stock in Google, or you can lend money to Google.
Yep.
When you're buying stock in Google, you're buying a share of the future profits.
Mm-hmm.
Those profits are largely unknown. You might be able to plot a reasonable path for the future, but those profits are largely unknown. And that stock is probably going to be fairly volatile. Even the strongest companies have volatile stocks over time. So your payout is quite uncertain on that. With a bond, it's a contractual obligation for that company or that entity to pay you interest at a set rate, typically a set rate over a set period of time, and to give you your principal back at the end of that bond's maturity. So there is quite a difference in the level of uncertainty of those two things. And that's why typically you'll expect to get a higher return on the stocks, the bonds.
Yeah, because the bondholder gets paid first. The stockholder only gets paid after all of the interest obligations have been met. So yeah, so you do expect a better rate of return for sure. But I mean, in that particular example, Josh, I mean, there's the liquidity risk isn't as high because typically that on a publicly traded on both sides of that, you're not dealing with liquidity. You're dealing more with the volatility risk. And maybe if you subscribe to the Nortel theory, maybe one day they'll go out of business, but that's probably a fairly minor concern. It's still unlikely to happen quickly, so you'll get some of your money out for sure. So it's not like a crypto bet or going to the casino or investing in a startup wind farm in Montana or something of that ilk.
Yeah, for sure. That's just one example. And generally speaking, your stocks are going to get a higher return than your bonds because of that degree of certainty.
Yeah.
But I think the other thing to keep in mind is higher expected return doesn't always mean a higher realized return.
Yeah, for sure. And this is where the investment industry kind of hides behind its own math a little bit, right? Because if something's not going well, it's like, well, you just have to wait for it. It's on its way. You need to take more risk. You need to deal with the volatility in order to win. And sometimes that's used as a bullshit line to hire unmitigated trash. And so it's one of those ones you can't just say out loud, well, I'm just going to buy, hold, and prosper, to steal a marketing line for an old mutual fund company. Just because you've bought something and it's gone down, it's not a truism that we'll just hold on to it, it's going to go back up. There can be fundamental reasons as to why something is not working out. There could be a fundamental flaw that was invisible or not apparent that becomes apparent. So just taking on more risk is not a certainty of having a better outcome over time. And that's where it gets super complicated because that's where it takes a lot of wisdom to figure out, okay, what room am I in here? Am I just getting bad advice or do I just need to be patient? And honestly, that's the most important conversation to have. And it doesn't lend itself to math with 2 decimal points. It just doesn't. And that's where good financial advice can help somebody make a decision as to whether this is something that I need to jettison and get out of or something that I just need to ride out the wave.
So you mentioned the lottery ticket thing and the gambling thing before, which I think are good examples where higher risk doesn't necessarily mean higher return. But what other examples can you come up with where there's a inconsistency between the higher risk, higher return idea?
I think the stock market is the best one because once you get beyond developed companies and get into companies that are more growth companies and or don't have any income yet or have got a brand new business model that hasn't proven itself yet, then if you go from the S&P 500 into the micro caps or you get into the new issue space, you're taking on actual risk of loss there. I mean, you're in the stock market, you can go from a volatility risk to a risk of loss. And sometimes you don't notice when you pass that signpost. Like you don't notice that you've gone down the dark road a little bit and this product or this particular option may just go away. So I think that the dealing in broadly equities, that encompasses everything. That encompasses from stuff that's pretty stable, is going to pay you an income, to stuff that may be gone in 6 months. And that whole category sometimes gets spoken about as if it's homogenous, and it just isn't. And again, I'm thinking IPOs, I'm thinking, limited partnerships.
IPOs is a good one. Yeah.
You know,
Yeah. Some of like the real venture type stuff that we used to see, like the like the labor sponsored funds and those types of things up here in Canada. Those are good ones. The one sort of obvious example that comes to mind for me is concentration, or having a high degree of concentration in your portfolio. Like if you pick one stock, your expected return on that one stock on, if you just kind of like pick it blindly, is really not all that different than the expected return on the market as a whole. But your risk with owning one stock versus owning the market, or owning 500 stocks, or owning 1,000 stocks, or whatever it is, your risk with owning one stock is exceptionally high.
Well, that goes back into ways to manage risk, right? So if you're trying to manage volatility risk, then putting together a diversified portfolio is a valid structure to try to deal with that. So, I mean, I think we're stepping into the next chapter of the conversation is how do you manage risk, and at what point do you avoid it and what point do you manage it? So some of it's how well can it be managed? It's funny, we've had the conversation internally about hedging currency and, trying to manage currency risk, and the different methods of managing currency risk. And there's a real cost in that world to manage the risk. So it's another one of those ones you need to understand the risk you're trying to manage and then weigh it against the cost of managing it versus just exposing yourself to the risk and letting it be. In the investment space, it's, am I managing risk of loss? Okay, so maybe that's just, I need to make sure that it's a minimal allocation to my portfolio. Is the risk of volatility? Okay, so I need to make sure that I've got diversified and perhaps uncorrelated assets. Is it risk of liquidity? Okay, I need to make sure that I keep 2 years expenses in cash just in case. So there's different strategies to manage different kinds of risk that line up. But you introduced something that was offhandedly talking about labor-sponsored venture capital, near and dear to my heart because that was right in the middle of my career. As soon as you start trying to accomplish a non-financial goal with a financial asset, you add another whole layer of the way things can go wrong. Because you introduce incentives into the equation that are not natural, that 99.9% of the time will get in the way of the true goal, which is growing your investments. So you got to be really, really careful in the world of the accomplishing non-financial goals with financial assets, because it's something that sounds really good, but you're adding risk to your portfolio. And even with our portfolios that we've kind of leaned in the way of trying to be a little bit more conscientious about things, we've noticed that it leads to a certain security selection that has a different volatility profile. Adding something in that is not specific to maximizing your return for the level of risk you're willing to take does change that. And you should try to be aware of that and quantify it where you can.
No doubt. Yeah, there's obviously different ways to manage risk, as you kind of went through them. And when you talk about risk management, one of the things that I was thinking about was kind of like a different sort of risk is reasons why we use insurance. So insurance is kind of the opposite of the lottery ticket.
Yeah.
It's like you have, it's in some ways you have a negative expected value from insurance. Like if you ran your insurance policy through in your life, a million times, you're going to lose money more often than not. But you're protecting on the one catastrophic risk
Yeah.
that if it comes up, your life is over, right? Or your financial life is over. Like,
Yeah.
if you pass away and you got young kids and there's no savings there, then what's going to happen?
Well,
So
yeah.
there's situations where you might actually actively have a lower expected return, but it deals with a specific risk.
Well, I think as I alluded to earlier, there's a cost to managing risk. There just is. Like you're going to have to give something up to manage that risk. I mean, the origins of insurance gets traced way back to when they were sailing ships across the ocean and, hoping they didn't get wrecked in a storm. So 5 ships take off, the 5 guys get together and say, okay, listen, I tell you what, however many ships make it back, we'll take whatever came back and we'll just divvy it up between the 5 of us. Deal? Deal. Now, because there was no other way for each of them to take on all of that risk themselves, they, made this deal. And basically, it's a pooling of risk, taking a group of people with a similar risk and all agreeing on terms to say, if something bad happens, I'm going to be made whole, or it's going to reduce the effect of this happening, or life insurance, it's going to pay my family an amount of money. But it's another one to understand the cost, because there's investment products out there that come out of the insurance industry that carry a very high premium on them that are protecting against capital loss that really don't make a ton of sense when you take a look at some of the numbers on what they think they're protecting from and what the actual historic outcome has ever been. So understanding what you're protecting, why you're protecting it, likelihood of it, and the cost of it are all very, very important things. Lower risk isn't always bad, it isn't always good. Higher risk isn't always bad, isn't always good. It depends on the circumstance.
So fast forward to today, look at the world of investing specifically. Where do you see smart risks being taken? Where do you see dumb risks being taken? Are there some pockets of risk that is more akin to driving blindfolded?
Well, we're in territory in the tech space where you've got some stuff that we may be in the middle of a right sizing of the technology space because expectations maybe have gotten a little bit further ahead. You take a look at things I always describe as an asymmetric risk. What is the realm of possible upside surprises versus the realm of downside surprises? And that often can be instructive in understanding how awesome the world has to be in order for a really high flying investment opportunity to continue on its path. And I love it. The line I read one time, it was like in order for Amazon to have a same valuation to Walmart, it would have to have a 100% market share on two Earth-sized planets. So when you start getting into that realm, now again, we could get into a bigger debate about the efficacy of different ways of tracking things for sure. But at a certain point, something just runs out of air, like it flies too close to the sun. So I think right now there's probably some ill-advised chances being taken in the tech space. And it's based on a fundamental belief that we're entering a period of amazing technology advancement. That's without a doubt. But to make that an investment, like that was the old rationale, marijuana is legal, therefore marijuana is a good investment. No, just because something's going to be bought or sold doesn't make it a good investment. Those are two different animals. I do think that there are people who are overly afraid of the overall stock market. I think the global economy continues to prove itself to be able to reconfigure its output and provide value to shareholders regardless of how hard we try to mess it up. So I think that that's a risk that's a bit over. It's a bit prevalent in people's minds. It doesn't necessarily need to be there, but it's based on situation. Like if you're 85 years old and you're just looking to pay your rent, then you don't need to be taking the volatility risk. You probably don't have the timeline for it. You don't need to be taking it. But again, if you're 30 years old going, I'm afraid of the world, I'm going to put it all in my savings account until the world straightens itself out, then invest it. You're not managing the risk appropriately.
But some of these leveraged ETFs that I see today, I've written about them recently for our team. That's one of those risks where you're maybe not going to get the appropriate amount of compensation for the risk that you're taking on. And here's a situation where, so a lot of these so-called leveraged ETFs, they're designed to give you 2 times the leverage. So the stock goes up 10% one day, your leveraged ETF in theory is going up 20%. The stock goes down 10%. The leveraged ETF in theory goes down 20%. So you might look at it over time and think, well, if the stock's up 50% over the next 10 years, then all of a sudden I get 100% with this leveraged product. But the way that leverage works, if you end up at zero, that's it. The game's over. You can't recover from that. And a 50% drawdown on a stock is not extremely unusual.
Oh,
So
no,
you're
let's hit that
playing
with
with fire.
no, no, let's hit that with a hammer. A 50% drop is 100% of your money. Your money gets lost first. Okay, so in a leverage situation, a 50% drop is 100%. So you have just wiped yourself out. So I think that, again, we would sit here and agree that equity markets over time absolutely are going to trend higher, you know, but in some of these leveraged, like at 5 to 1, I mean, we've seen those too, right? So if you go that, it's like if it ever suffers a 20% drawback, you're 100% wiped out. So it bites way harder on the downside than it adds on the upside. But it's a product people are willing to buy. And at certain points, you cross the threshold into the house is going to win because they're going to make money offering that product to you. And I'm not sure exactly where that point is, but we're seeing it creep into, and this is a really good uh, point to make, I think, on this particular pod. We're having prediction markets show up in investment accounts now, and that's nothing more than a bet. And the house is going to take its rake off of the top, and you don't know more than anybody else where interest rates are going to go or the other things you're allowed to bet on. And the proliferation of sports betting and people jumping on their phones and just placing bet after bet after bet. Well, there is a risk of loss. There's liquidity. Yeah, you lose liquidity because you lost the money. So I guess that's both a liquidity and a loss risk all in one spot. So
Yeah. Yeah. I think anything that has binary outcomes with investment, and binary by that I mean if things go well, you get X number of dollars. If things go poorly, you get zero. Like a lot of times that's what we're talking about when we're talking about options in some of these prediction markets. I think these leveraged are a binary bet to get 2x. If things go poorly, you get zero. And I think more likely they're going to be zero than not. So those are ones I think when I look at the market today, if I could generalize, they're problematic. Let's put it that way.
it's just if things go poorly for any moment in a moment in time, like it doesn't, they could still work out just fabulously, but there was a bad day, you're wiped out. You don't get to hang around for the recovery. Why? Because you ran out of your money, and the person who gave you money took their money back. So, it's nonsensical. It really is, and it is way more like betting than it is like investing. And there are those who sell the product, who are advocates for the product, who would say, "Well, if markets are always going to go up, you should always be leveraged." You know what? I don't think that that's safe, fair, or reasonable for the vast majority of the population. Because you alluded to it earlier, Josh. We haven't really gone back to it. You got to have the stomach for it. Like if you're gonna, be on medication because you're looking at your account every morning, then whoa, 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 you got to get out of the game. I don't care what mathematically you should be doing. Like, and I've run into people like that. They just get so overwrought with being so tied up in what's going on that it becomes a complete distraction for them, and they just shouldn't be there.
Yeah, no doubt. Any last thoughts? Final words of wisdom?
I think, Josh, the genesis of all this was that, we have had clients who have left us because of they're chasing a higher return because they've been convinced by taking more risk they're going to get a better return. And I think that's a gross oversimplification of the equation. And, I think it's a heuristic that gets applied. It's a shortcut that gets applied for people that more risk equals more return, and therefore I should take on all the risk I can. And that doesn't hold up to scrutiny, but it is used to motivate people to move assets and make decisions and allocate capital. And I think that that's overblown. It should stop. And people, if you're hearing that pitch, if somebody's saying take more risk, get more return, and that's all there is to it, that's a real red flag. That's a real danger because there's no universal way to say that.
Yeah, I think you very well might get more return by taking on more risk. But the question is, do you need to do that?
And
Is
what,
is it is it giving you a higher probability of accomplishing your financial goals? Because as we said towards the outset, a lot of this comes down to risk is defined relative to your financial objectives.
yep.
And a higher return expectation may not get you closer to your financial objectives. In fact, as you said before, a lot of people could very well just have a GIC portfolio and accomplish all their financial objectives, in which case that's totally appropriate for them. So it's always within the context of if is what I'm chasing actually going to help me accomplish what I want to accomplish. And it's certainly very easy to chase a higher return with higher risk when markets are really good, which they have been for the better part of 4 years.
Last year this did really well, so I want to invest in that. Like, oh no, big shooter. Like that's not what. No, please don't be that person. So, but anyway, it's a complicated conversation. It's a nuanced conversation, and if you want to have it, give us a call. We can give you 2 cents on what your risk profile might be that maybe you're not aware of.
As always, thanks for listening to Barenaked Money. And if you're starting to wonder whether your current financial advice is appropriate for you, if it's as clear and disciplined and well defined as it needs to be, give us a call. We're always happy to have a conversation. Signing off, Josh and Colin, portfolio managers with Verican Capital Management. Our team's always open to new client conversations. So visit betteradvice.ca if you want to get started.
Have you ever wondered why your financial advisor is making a recommendation? In an industry where conflicts of interest are everywhere, it's important to understand how they affect you. For more info, contact us at Verican. You can find us at annoyingthecompetition.com.
For more information on the subject of today's podcast or any other financial topic, please visit us online at verican.com. That's VERECAN.com.
There's plenty of information there, or you can reach out to someone on the team. Thanks for listening.
Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Barenaked Capital Management Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Barenaked Capital Management Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.